working or you have a connection issue, just press refresh. Just hit F5 or refresh. 95% of the time, it's on your side. The problem will be on your side 95% of the time. When it comes to questioning, guys, we don't answer nugget hunting questions or bottom feeder questions. We're a school, not a copy trading service. If you do ask the same question repeatedly, we will eject you from the webinar because you're actually monopolizing the Q&A area. There's probably a very good reason why we're not answering your question. Just a little bit about me, resume, CV. I was a Pan-European Equities division as a trader at the following firms, Goldman Sachs, Lehman Brothers, JP Morgan. Left the professional side to travel the world in May 2007, just before the financial crisis. Pretty good timing. Went back to the UK, did a TV show, which many of you might have seen, which is available on YouTube, called $1 Million Traders. That was with the BBC. Then I went traveling around the world again, set up the Institute at around end 2010, beginning of 2011. When it blew up in 2013, that's when I migrated everything over to Singapore. Obviously, Ben Berg-Green is on today. Ben, you want to run through your resume?
Yeah, hi, good morning, guys. Name is Ben. I'm more from the asset management buy side. Worked for a bunch of large asset managers, including TradeWinds Global, owned by Nuveen. We had like 200 billion in the management here in LA. Also managed the Asian trading desk for GE Assets pension fund, and started a quant shop hedge fund in London back in 2001. And before that, I was on the trading desk of Franklin Templeton covering European equities. I was also a commercial pilot in the mid-90s, and I did a bit of a career switch. So I've done a few things. Now I'm pretty much semi-retired, full-time trader. I trade stocks, options, futures myself, and an IT PM mentor. So, yeah.
Cool. Cheers, Ben. Just on some of the stuff that's coming in the Q&A at the moment, there's about 5 or 6 people that keep spamming the Q&A, telling me that they can't hear us. Just hit refresh. Hit refresh. There's a couple of guys that hit refresh and they're telling me it's now working, okay? There's nothing we can do our side. There's nothing we can do, okay? The vast majority of people, when we did the sound check at the beginning, literally scores and scores of people say they can hear. Totally fine. So just hit refresh and you'll be fine. Just on what the Institute actually does, because there's a few misconceptions out there about what we actually do. Right now we're above 900 retail traders globally trading their own capital, and we have up to $10 million that we can deploy to Institute traders on power of attorney. That gives us basically a total of the retail traders capital and ITPM capital, 40 million on margin. And that's when we leverage that on margin, that's a typical around 150 these days, 150 million leveraged risk. Now, to become an Institute trader, you've got to take our online educational programs or complete a mentoring program with one of our mentors like Ben. Now, there's no obligation to join the Institute at all once you've done our online education. The whole point of it is that we know that you're educated to a high enough standard to come into the Institute when you want to. We're not going to force people to come into ITPM once they've taken the exam. You can come back in a few years, come back whenever you want. It just means, as a qualification process, we know you're good enough to come into the community. Now, some of you might have heard about our Thailand program. It was set to be in April. It's now going to be done online. We're going to follow the same structure as our 2020 program, which was really successful. We're actually going to be doing it over Zoom. If you're interested in that, it starts on April the 22nd, finishes May the 4th, but then you do 12 weeks of mentoring after. Right now, only Jason, Raj, and Ross are available in terms of the mentors. 12-week programs are going to go ahead as normal after the classroom sessions. And what we'll do is do a makeup class in April 2022. So instead of 10 days in Thailand, we'll do 5 days. So we'll have 3 classrooms back to back with a day either side. If you're interested in that, just send a message through the website. You actually apply here, where you apply for remote trader mentoring programs, which are held for 12 weeks over Skype. If you look at our backgrounds, you can see that we've got a high-level professional background, very, very different to what's out there in the current trading education market. Okay, now let's kick things off. How to smash 2021 out of the park. What a year 2020 was. Let's have a look at the schedule. We're going to be looking at YOLO trading, looking at the Robinhood model, the bigger increase in options volume. Ben's going to be looking at market breadth and where we're going to go from here. And then we're going to look at how you basically have a good chance of smashing it out of the park in 2021. What do we mean by a YOLO trade or a YOLO call? Okay. What do we mean by that? Well, it's a you only live once position. Okay. This has become very, very typical now in the retail trading industry for a number of reasons that we're going to look at. But first, it's really a lot to do with what happened in 2020. Okay. So 2020 was really just a once in a decade scenario. Obviously, to try and make big returns from the volatility due to COVID-19, the economic lockdowns, and the central bank responses providing liquidity. Now, what happens? Okay, in a situation like COVID, where there's an economic lockdown, when people are sitting at home, whether it's greed, boredom, the chaotic events that are going on, they get sucked into the market. A lot of people come into the market for the first time. Okay, and what it does is it creates a situation where a lot of people come into the market with little money. And of course, there's going to be people who are going to provide that service to you, okay? This definitely happened in 2020 with commission-free trading and the Robinhood model. We'll get onto Robinhood in a second. But it's important to really understand it because it really changed everything in 2020 in terms of the way the retail trader thinks and operates. In the bigger picture, this is a fact that no one can change because it's been the case for decades. The vast majority of retail traders have always lost most or all of their money trading financial markets. The question is why is it going to be different now? Very strong clue, it just isn't, okay? It's just a different dynamic. So we've just got to grow up here and think about what's really going on, okay? So let's have a look at the Robinhood model. What is Robinhood? Robinhood is essentially a brokerage company, but a free trading app to low-value retail traders. Okay, so people who want to open trading accounts with very small amounts of money. They got 4.3 million daily average revenue trades, DARTs, in June 2020, and this outperformed all the publicly traded brokerage firms. So we're talking like Interactive Brokers, all of these guys. So the marketing really worked. The marketing for free, commission-free trading really, really worked, okay? And obviously COVID sucked a lot of people into the market who were sitting at home watching the chaos in financial markets, watching their pension going down in value, and people got sucked into the market. What does their data show? Their data basically shows that the Robinhood traders on the app are mostly trading the popular names like Amazon, Tesla, Apple, all of the FANG stocks, and just punting them around, okay? That's an issue in itself, because one of the problems with retail traders is they constantly lack original ideas. Retail traders tend to take their ideas from the media, okay? So if something is a popular name, people basically trade it because they can't think of anything else to do, okay? This is something that's very, very apparent all the time from students that come to us. We look at retail trading accounts all the time where people operate outside ITPM and they all end up with the same positions all the time. And right now it's really, really obvious, well, in the last 6 months, what people's positions actually are. Now, the data showed that the majority of Robinhood traders actually lost in 2020, lost considerable money, even though it was an amazing trading environment. Like if you're a pro trader, 2020 was absolutely amazing. Okay, in fact, I can tell you now, it was our best year in over a decade. Okay, it was my best year in over a decade. But also, retail traders are trading commission free, and they still lost money. So why is that? The problem is not commission free trading. The problem is the approach that everybody takes. Okay, but let's have a look at the Robinhood model a little bit closer. What essentially are they doing? They're shifting the business model, and it's always been the case in trading that if you basically pay little to no commission, you're going to pay elsewhere. They will always find a way of making you pay. Okay, but the way they're getting you to trade a lot of the time is they basically gamified trading and investing. So they're basically sending regular push notifications all the time about individual stock positions, which gets you addicted to the app. So when you make a trade, all that's happening is you're getting lots of notifications all the time, essentially digital confetti falling inside the app. And also they've got a watch list of stocks for users to track all the time. And they basically make it seem like it's a video game. Now, obviously their main pitch is that you get unlimited free trades, but it's been absolutely proven statistically that day trading doesn't work and is not consistently profitable as a strategy to use all the time. Okay, specifically when you look at equities, you're looking at an 80-20 situation where 80% of the time through our history, day trading is not an approach that is consistently profitable. Obviously, when you get big increases in volatility, there's short periods of time that you can take advantage of the volatility. But roughly 80% of the time, statistically, it's not possible to consistently get good returns out of day trading. Now, the way they do this is pretty straightforward. Robinhood, what they do is they charge an annualized rate of 5% on overnight financing. So that's an annualized number, 5%. So if you put that over 365 days, to hold an overnight position, it's 13.7 basis points per day. What that does is it forces retail traders into very short-term YOLO positioning. Now, why does it end up in a situation in terms of YOLO positioning? Because they seriously lack a large amount of ideas. So if you've only got like 2 or 3 ideas and you're trading on a platform where the overnight financing is 5%, what's going to happen? You're just going to day trade 2 or 3 stocks all the time. That's what they end up doing. They force you into this position because it costs a lot to hold positions overnight. So people close their positions before the market close, or they get forced into YOLO options trading because the downside is the premium that you pay for the option, a call or put. Okay. Now, when this happens as well, it's again a bit more dangerous as a compound effect for retail traders, because most retail traders don't understand options trading. Okay, how options are valued, how they trade, and also that they have to be right by a certain time. Okay. Now, obviously, despite not charging commissions, one of the things that they do on top of the 5% on overnight financing, they sell their order flow on a per trade basis. And the average that they've reported, it comes out at about 45 cents per order. Okay. Now, what does this mean? Well, it just means there's a conflict of interest. So it means that they still make money. They make money every time you trade, because the buyer, the person who's buying the order flow, they pay on a per order basis. Okay. So the more you trade, the more Robinhood makes. So they're forcing you to trade very short term. It's a very clear conflict of interest, and it's basically rejigging the business model and has replaced the revenue formula of volume times price times the commission rate. So now they're making their money on overnight financing and selling your order flow. So of course, they want you to trade a lot more because they get paid per order, okay? Now, options volume was up massively in 2020 versus 2019. The COVID-19 pandemic really helped options volume explode, obviously because of the appeal of the limited downside. So option premium for unlimited upside. The YOLO trade is the dynamic plus having all of your margin in your account on one or two bets that the media or Twitter trading gurus have basically fed to you. What everyone's doing is convincing you to play this game, okay? Of course, some trades have made money. These are the ones that you hear about on social media. But there's a problem, and this has always been the case in financial markets, okay? Buying lottery tickets really isn't a consistent way to make money. It's a strategy for the mathematically challenged. You'll obviously hear all the time the unicorn stories online and in the media. You'll never hear the horror stories. The horror stories happen to the majority of retail traders. There were two moments this year, and March 16th was the worst one, where there were massive forced liquidations of millions of retail trading accounts, okay? You never hear these stories in the media. You never hear it online. All you hear is the unicorn stories, okay? The one guy that made a killing on one trade. And that just gets everybody to play YOLO again. What it also did, COVID-19, was bring out all the traders that thought blindly selling premium was a good idea. And this caused a lot of traders to blow up, or even worse. Like, they ended up owing the broker money. But let's have a look at a few data points to understand what's actually going on in the market here. We're looking at the options expiration calendar here for 2020. But you can see in 2019 here, we're looking at the June expiry in 2019. We got just over 21 million contracts trading. If we compare that to 2020, we're looking at the June expiry in 2020. We've got just under 36 million contracts trading. If we look at the September expiry, 2019 September expiry, we're looking at 24 million contracts trading. And then in 2020, we're looking at 37 million contracts. So you can see there's been a massive spike in options trading. Basically, in the June contracts year on year, you're looking at an increase of about 15 million or 69%. Now, obviously, by September, volatility came down a lot, but there's still tremendous volume growth year on year for the September contracts. That was up 13.5 million contracts, so up about 55%. So this is not really to do with volatility. This is to do with a new way of trading, and retail traders are embracing this, and it's a very, very dangerous game. So what this does is, for guys like us, it's great. Don't get me wrong. I'm not complaining. For guys like us, it's great. There's a lot of dumb money in the market. It's great news for guys like myself, Ben, ITPM traders who have been educated properly. We were able to take advantage of all this craziness in 2020. All of these forced liquidations, all of the crazy stuff. We took a lot of advantage of that. Trading against dumb money really does create opportunity, but there's a big problem. This is all great till it ends, and it absolutely will. It's going to end. So this is kind of a word of warning to you guys. As we go into 2021, please do not get sucked in to trading in this way, okay? Do not get sucked into trading the YOLO positioning where you've got 2 or 3 ideas that are badly thought out. You're following the mainstream media or the latest Twitter guru online, and you're just going in on the Robinhood app or similar apps, similar brokerage businesses, and you're just going all in on a couple of trades where you're buying a near-term call option, and then it just decays to zero. Okay, it's not going to be a viable strategy for a very long time. Of course, there will be occasionally a unicorn winner, but it doesn't matter. If you heading into 2021, it's of the opinion of ITPM, this is going to unwind in a big way, and it could happen in Q1. So I want you to be careful. This is a word of warning. This could happen very, very soon. And Ben is going to actually discuss it with you now. So I'm going to hand over to Ben for the next part of the presentation.
All right, so let's just dig right into it. One second here. So I'm going to talk to you about index performance, dispersion, and breadth. Okay, so when people talk about the market and you think about the S&P 500, it's very easy to think that that's, you know, a broad, wide index that best represents what the market is doing as a whole. But when you look further, you know, in more detail on the inside, basically under the hood of the index itself, we see that due to the market cap weighted structure of the index, it's heavily exposed to certain stocks and sectors. Looking under the hood, basically like that, looking at the internals, is what we call breadth. Okay, and this has been much more of an issue the past few years because we have big tech stocks that are taking up a huge portion of the index. So now we actually have a situation where the top 5 stocks of the S&P 500 make up over 20% of the index. And the biggest stocks that is responsible for this is what we call FANG stocks. Okay, this is Facebook, Apple, Amazon, Netflix, Google, and it's a term that was created by Jim Cramer a while ago just to describe the newer tech names. Kind of give it a little catchy phrase. You can also add Microsoft into it because Microsoft is the second largest component of S&P. And also Tesla was just added, right, last week. So if we add Microsoft and Tesla, I actually have a new version called Fat G-Man, which is now the 7 biggest stocks of the S&P 500. They're all tech, and I'm gonna show you why it's important to keep an eye on these names. All right, they make up quarter of the index weighting, and they tend to be responsible for big portions of the move. And we saw that leading out of the March slump after the COVID crash. These stocks took off and basically carried the index, out of the slump, while most other stocks were lagging. And now we actually have kind of an opposite situation. So if you look at this table, we can see the market, the percent of the S&P 500 each stock represented in March, and then now, or as of a few weeks ago. And most of the components didn't really change that much, okay? But Tesla, that was up 600% during that time, went from basically 40 basis points to 1.7% weighting, which is where it is now, which is pretty huge, and especially since it's happened so fast. So if we break this down, and we say that, if each of these stocks fell by 30%, and I'm not saying this is likely to happen, this is just a theoretical example to show the math here, okay, and everything else stayed flat, there would be a 7% pullback in S&P. And Tesla itself definitely has a huge impact on its own. So we kind of have a situation now where, one or just a handful of stocks can really drive the market. And the reason why we're bringing this up is because when you start looking closer at some of these names, the things like put-call ratio is super low, meaning that there's investor complacency. There's just a lack of interest in puts, and everybody's buying calls because they think it's just going to keep on going. And Tesla is really the only name that has kind of gone up over the past 3 months. And a lot of that was due to the fact that it was being included in the S&P 500. So it was bought up into that. But most of these other stocks are actually flat. They grinded sideways for 3 months. And we're going to start seeing some warning signs. Okay, so this is what the put-call ratio looks like on a chart. So what this means is for these two stocks, and the other, by the way, the other names, the other 7 stocks have pretty similar pictures. But we're now in a situation where we have record low put-call ratios in many of these big drivers. And that, it can last for a little while, but typically when this happens, it's just a sign of extreme complacency, and something usually needs to come around to adjust it. Okay. Most of these stocks, like I said before, most of these stocks besides Tesla topped October 2nd, and on average they're actually down about 10% from their highs. We had last week or so, Apple and a couple of other ones had a kind of an attempt to grind higher, but they're still down on average since the top in October. In the meantime, the major indices, especially like the small cap, for example, has just charged higher, right, into new highs. And there's been this shift into value stocks. All those names and sectors that were completely beaten up from COVID start to crank higher. That's usually a good thing. So when we get wider participation in the market, that means you have a wider breadth, and it's a good thing. It's a bullish sign. However, in this situation, we also have thinning out of the big tech names, and that's definitely something to keep an eye on. Okay, so overall, it's good, but when you look closer with a microscope, we're starting to see that if these big tech names can't participate, it just can't really go on. You're not going to have the market carrying higher without the big tech names participating. So back to market breadth. I do a lot of studies on this. I do a lot of testing, and I build indicators and models and strategies and stuff like that. And I have built some models around breadth, and what they do is that they provide detailed picture of what's actually going on underneath the hood of the market. And it gives us information about direction, momentum, trend, and also indications of fear and greed, and if we're in an oversold or overbought environment. And I use this a lot to, I use this for my futures trading. When I talk to my guys in mentoring, we use it for, option structures. And it looks like this on a chart. Okay, so this is the S&P 500. We're using the ETF SPY as a proxy, basically. So you have 3 different breadth indicators here based on various elements of the behavior of the underlying stocks. And bottom line is that when they're all green, if they're above 50%, this is as a percentage, by the way. So meaning that when they're above 50%, we're in a bullish environment, and the market tends to go higher. When they are above 70%, it goes dark green, and it's that's basically the beginning of a very bullish environment, which we are in now. However, it comes to a point where too much of a good thing can be problematic. I'm going to see that in a second. So we're now at metrics above 80 to 90%, which is really high. Okay, we haven't seen that. I mean, I've been watching this stuff for over 10 years, and I've never seen that happen. And that's important because if you look at other things, the VIX continue falling lower, and other data that we look at, the market is pricing in as if the coronavirus not only never happened, but that it's actually bullish for the global economy. And that's kind of, what's going on. And I seriously doubt that's the case. And I think, and then in the near future, they're going to look back and say, well, that was ridiculous. So it's kind of a Goldilocks market environment based on greed, pretty much. So something's probably going to have to give it pretty soon. So, when you're a professional trader, you have to be a wolf, okay? Most people are sheep. Don't be a sheep, because then you're just following everybody else, and you need to be ahead of the crowd. That's the only way to make money doing this. So I do a lot of quantitative testing. I do this on fundamental data, technical data, pretty much across the board. And I'm always looking for edges and what I call alpha generators. And that's asking the question, which everybody should be asking, is what really has meaning? Okay, what actually can give you some type of prediction about what's going to happen in the future? Because most of the stuff that people look at is honestly completely useless. It just doesn't help at all. It just makes you feel good that you're looking at stuff that everybody's talking about. But how do you know if something actually has meaning or not? Well, you need to go through. You need to first of all ask the right questions. I need to just test and test and test. And I've done this on thousands of data points over many, many years. This, what I'm showing you here, is just a tip of the iceberg of the stuff that I look at. Okay, but when I tested this specific scenario, so if you are looking at, let's say, about $100,000 worth of the SPY, every time all of these breadth indicators were above 70%, what would have happened over the next few months? And you're going to see that the results over a couple of months was definitely not good. Okay, it looks like this. Okay, so the number is trading days. So 40 trading days, which is basically 2 months. So what this graph represents is basically saying over the past 10 years, if you bought $100,000 worth of the S&P 500, every time these breadth indicators, all three of them, were about 70%, after 2 months, you lost 20%. That doesn't mean that it's always going to be the case, okay? But that has been statistically what has happened in the past. And now, keep in mind that now some of these indicators are above 90%. So, we'll see how it goes. So, having really strong positive breadth is not something you want to go against. So it's not like, okay, now we're extremely positive, so now we should be going against it and shorting. That's like standing in front of a freight train that's moving 100 miles per hour. What it does mean is you need to really keep an eye on this stuff, because when this stuff starts turning around, it could be an issue. All right, so positive breadth is good, but extreme measures are not. So leading into the March crash, these indicators were all above 70% in January, actually. And then the stock market, had another attempt to go higher in February. But all these three indicators were actually leaning over. And by mid-February, they were all going towards negative. Okay, and by February 25th, they were all negative, and then everything just unraveled after that. So that's what I mean. Okay, we just have to keep a real close eye on this stuff. So when these things start rolling over, the fat G-man could really take a tumble, I think. We'll see what happens. But so by the way, I share these indicators with my with my mentees, and we discuss how to structure trading positions around them. Okay, so I just want to emphasize that strong bullish momentum is not bad. Okay, but it comes to a point where you have to keep a real close eye on this stuff, because when things start rolling over, it could be hard and fast, especially considering where it's coming from. So where do we go from here? This is a fragile market, clearly. And it's really super important, especially now, to know how to position a book accordingly, and what to look for. And I think index investing, which I'm generally, I'm a big believer in index investing, but there's a time and a place. Okay, and now for the next at least until this situation is kind of asserts itself and they get more clarity on COVID, I think we're going to have more volatility, and index investing is going to be a really tough game in the near future, probably. That doesn't mean that there won't be plenty of opportunities for stock pickers, stock pickers or options traders, because there are opportunities that we see every single day. They actually have more opportunities that we can trade. At least that's the case for me. So the problem, with most retail traders is that they just don't know where to look. They have no process. They just don't know where to start. Everything is pretty much following somebody else. So it's like the blind leading the blind, and that's super evident in the YOLO options trades in this past year. So I'm pretty sure things are gonna unravel, especially these type of trades, and a lot of people are gonna get caught out on it. So be careful, get educated. But yeah, so with that, I'm gonna hand it back over to Anton.
Cheers, Ben. Okay, guys. So what we're trying to point out here is, if you think back to what I was talking about at the beginning, the YOLO trading environments that we've seen in 2020, it's created a lot of bad behaviors in the market, and we've seen this a number of times before. So we've seen it in the late 90s, we've seen it in 2007. We could be in a situation here, as Ben's pointed out, where the tree gets shaken and all of the weak hands fold, okay? What do we mean by the weak hands? We mean retail traders with little capital, okay? Trading on margin levels, highly leveraged in the options market. Everything that we look at is pointing to a tree shake at some point very soon. What we're saying here is that if you want to actually do well in 2021, going into 2 or 3 bets where you've got just a few stocks or a few options positions and you're all in on something because you really strongly believe the narrative and you've got this idea from mainstream media or the latest Twitter guru, okay? It's not a viable, consistent trading strategy. You're going to get caught out for sure. And this is our kind of warning against that, okay? If you want to be doing well, if you want to smash 2021, what's wrong with 50 to 100% returns? Nothing. 50 to 100% returns in 2021 will be amazing. And doing that, whether the market goes up or down, that's what we look to do every year for our students, okay? So on lower levels of capital, the 50 to 100% is definitely possible. We have a lot of guys doing that because they're taking a professional trader systematic process. And this is what it looks like, okay? We are in the 20 to 60 day time horizon, whereas most retail traders, the Robinhood guys, for example, and retail traders, even not on Robinhood, are on the left-hand side, like the 1 to 5. So 1 day to 5 days. And what a lot of retail traders do as well is they really mix the definition of trading and investing and mix it up. And they don't really understand what the differences are, okay? So typically you might see, a guy who goes long something because he thinks it's a good investment, but he's structuring it as if it's a trade, which is obviously just totally wrong, okay? So you'll see situations where people have, long-term positioning and short-term positioning in their trading accounts. And some are investments and some are trades, and it's all just mixed up, okay? The professional trading community are typically in the 20 to 60 day time horizon. And, whenever we speak to retail traders when they first come to ITPM, they're either at the extreme in terms of very short-term trading or the extreme up out till like 3, 4, 5 years as retail investors because they read some value investing book, okay? So it's all the popular stuff that people end up doing in the retail community. And what we do as professional traders, we're in the 20 to 60 day time horizon, the vast majority of times. So we're talking 80, 90% of the time, we're going to be in the 20 to 60 day time horizon, and we're going to be long short portfolio managers trying to carve out a return every year, regardless of market direction. So whether the market goes up or down, we actually don't care. We're just long short, absolute return. We make dollars when the market goes up, dollars when the market goes down. And we've got a constant flow of trade ideas. And the trade ideas are obviously subjective to the moment in time, but there's many of them, okay? Now, in that time horizon, that's pretty much the volatility sweet spot for all traders learning how to trade. Why? Because it gives you the best disciplines of trading and investing. Because you'll get all of the facets that you need to be a good trader, but you'll be trading essentially on fundamentals to begin with. And this is the way it works, okay? A pro trader systematic process, long short portfolio management, 20 to 60 day time horizon, splits up into essentially two parts. It's trade idea generation and knowing the theory of how to do that. So you learn the theory of how to generate high quality trade ideas, okay? It's all based on fundamentals. We're talking like 90% fundamentals, 10% timing. And then after that, there's the implementation of your idea. So if you have a trade idea, you have to choose a trade structure, and your trade structure is based on the 20 to 60 day time horizon, and it's based around catalysts within that time period. One of the biggest mistakes that retail traders make is they don't look at a time horizon for their trades and force themselves to be right before a certain time. You have to be right by 60 days, otherwise it's not a trade. If you go further than 60 days, it starts to become an investment. If you land in the 20 to 60 days, that's still considered a trade. And anything short term, so we're talking like 1 to 5 days, that's obviously still considered a trade. But the vast majority of times, that is not available as a consistent trading strategy because the volatility doesn't exist, okay? The volatility sweet spot in equities is 20 to 60 day time horizon. So you get the trade structure on between 20 to 60 days. Then, of course, you have risk management, okay? There's preemptive and there's reactive risk management. Preemptive is everything you put in place before you take a position. So some general rules that you won't break in your portfolio. Reactive is something that can never ever be taught in a video series. It's impossible. Reactive is what you do when a position goes right and when a position goes wrong. And of course, there's no rule book. Everything is subjective to the position itself. Of course, there's some best practices, but there's hundreds of them. It's absolutely impossible to teach unless you're doing it live, okay? So this is basically the job of a professional trader, to get the return over a year, but taking the long short approach in the 20 to 60 day time horizon and doing many trades over a year. You'll probably do about 100, 125 trades a year, something like this. If you really want to smash 21 out of the park, you've just got to learn how to do it properly. Retail traders really do concentrate on all the wrong things and do everything upside down. The most obvious to us is generating too few poor ideas. That leads to the concentrated bets that we're seeing in 2020, and then ending up spending the life of any trade trying not to lose too much money instead of just making money, and deploying some rudimentary risk management practices. You've got to learn how to do this so you can do it for the rest of your life. Now is probably it's an amazing time to do it, because as you've seen from Ben and the evidence that we've shown you today about what the market's been doing in 2020 going into 21, we could be seeing a big unwind soon, and retail traders are going to get really hurt, okay? If we get an unwind in Q1, like Ben's pointed out in his indicators, if that happens in Q1, there's going to be a massive shakeout. Retail traders are going to lose a lot of money. So you need to learn how to do this, not just in 2020, but for the rest of your life. Copy trading, which is what, everyone does. When you think about, the fat G-man and the FANG stocks that Ben pointed out, these are the positions that everyone has in retail all the time. Okay. Just think about that for a second. What edge do you think you have in knowing those stocks over the rest of the market? The answer is you don't. You just don't. You're just following the herd. As Ben pointed out, you're just being a sheep. Copy trading never works. Retail traders are guilty of it because they're short of time and they obviously get offered the hack. And you're also watching mainstream media and all they talk about is the big stocks. All they talk about on social media is the big stocks. All that's happening is it's someone else is coming up with the idea and you're attempting to piggyback off it. You can't get your next trade idea from CNBC, Twitter, Reddit blogs, chat rooms, the newspaper, or even worse, the fake gurus online. Copy trading is just for idiots, guys. It's for idiots. Like, do you really think guys like me and Ben go online and steal people's ideas? And our portfolio is a bunch of positions that we've got from mainstream media and guys online. Of course not. We generate our own ideas, and that's what we teach. All the guys at ITPM, they generate their own ideas. So if you become a student of ITPM, you learn how to do that. Copy trading is for idiots, guys. You'll always lose money. Why? Because you just have no idea what you're doing. It's really, really that simple. When it goes wrong, you won't know what to do. When it goes right, you won't know what to do. Whatever happens over many trades, over a long enough period of time, if you're copy trading, you will lose. You will lose everything. It's just the way of the world. Now, if you're interested in our Thailand program, send us a message through the link at the bottom there, itpm.com/trader mentoring. We're going to kick that off on April the 22nd. That finishes on May the 4th, and then you do the 12 weeks after. Available mentors for that are Jason, Raj, and Ross. For remote trader mentoring programs, that doesn't include the classrooms. What it includes is the 12 weeks over Skype. You can go to itpm.com/mentoring. And if you see our background, we've all worked at investment banks and hedge funds at the highest level. We obviously trade our own money now. ITPM has money available for people to trade when we uncover talent. The level of expertise, guys, at ITPM literally does not exist anywhere else in the trading education industry. We are quite literally the only game in town when it comes to stuff like this, okay? If you're interested in our online programs, we're predominantly in equities. Why? Because that's where the volatility is. That's where you get wholesale ideas, hundreds and hundreds of stocks, possibly thousands, but typically our universe is about 500-600 stocks that we can look at any one time. And then stocks in play, you're looking at about 60 to 80 stocks at any one time. First course, Professional Trading Masterclass video series. It's a top-down multi-asset class systematic framework with specific focus on the stock market because it's the most volatile asset class, and it's also combined with a bottom-up overlay. It's 80 to 90% fundamental, 10 to 20% technical and price action with professional risk management, tons of spreadsheets, 57 professional trading spreadsheets. You're looking at 36 videos, 38 hours of footage. Probably the best combination is if you take course 1 and course 2. The Professional Options Trading Masterclass includes 20 different options trading structures to basically not just obviously go long and short stock, but trading options to get leverage and doing it properly. So obviously we're not showing you how to just do YOLO trading with call options, but how to build a real portfolio of options positions from your trade ideas, which you learn how to do in course 1. So in the Professional Trading Masterclass, you learn how to basically come up with high quality trade ideas and build a stock portfolio, a long short stock portfolio. But with course 2, the Options Trading Masterclass, It's using options to structure the trades. So you can build an options portfolio instead. Third course, Professional Forex Trading Masterclass. That's something that you can obviously do a bit later on. Forex, there are opportunities, but we're not Forex day traders, okay? We don't trade Forex for pips. What we're looking for when we trade Forex is big macroeconomic moves, and when those macroeconomic moves come, we're looking for minimum 10% move in the Forex pair. It's a very fundamental approach, and you probably only get 1 or 2 trades per year, okay? This is something you can do later. You can make very good money from it, but the opportunities are not day in, day out, week in, week out, okay? It's not like equities. Forex is not like equities. You don't get the opportunities in the same way that you do in equities. We'll give you some deals today. If you want to do the PTM video series, instead of 2999, we're going to do it for 1295. The PTM plus the POTM as a combination, we can do that for 2495 instead of 2,999 times 2. If you want all 3 programs, we can do that for 3895. And obviously there's a massive saving there if you want to do all 3. The deals for being on here today will expire midnight on Sunday, January 31st. You can do it in 2 ways. You can either send the number. You can see the numbers in green. They're all different numbers. So if you send the amount to paypal.me/Institute of Trading, we do a check to see if you were on the webinar. As long as you're on the webinar, we know what the number is for. So we'll give you access to the program or programs. Or you can send a message through the contact form and just quote Smashing 2021 webinar delegate and then insert the deal. So if you want the PTM, just put PTM video series 12 months. If you want PTM plus POTM, put PTM plus POTM 12 months. Very easy if you send the paypal.me number. That's what it looks like. You just literally send it and we'll know what it's for. And if you want to get the if you want to do it via the contact form, you can just do it through the contact form there and send us a message. But that's it, guys. Short webinar today. A lot of information though that you've got to get your head around. I'm going to leave this on the screen. Ben and I can take questions for half an hour. Happy to answer questions in the Q&A. So fire away. Ben, is there anything you want to answer that you can see?
Yeah, I've been trying to just answer as much as I can here. But yeah, questions are kind of coming in fast that I can respond to. But I'm trying my best to answer everything, as much as I can here. So
there's people asking about trade ideas here, saying, I'm trying to pick up on a theme here across trade ideas. Yeah, there's a few.
Yeah, so a lot of people are, while you were talking, I think the biggest theme people asking about was our process. What do we look at? What resources do we use? How do we build our process? And most of these questions that surround that is kind of they're just too complex to cover here. So, but most of that is stuff that we cover in mentoring and through the courses. But I think the short version is, you do have to have a process, and you do have to get educated properly. And there was another thing also, people asking how are we different than any other course out there. And that's super easy to answer. It's because we all professional traders coming from, big professional backgrounds where this was our career. We're not, salespeople or whatever. So, and we all have Bloomberg bios to back it up. So I think that's answers that.
Yeah, with the questions on ideas, quite a few people are asking about, how do I generate ideas consistently. Yeah, we obviously get this, guys. There's a reason why copy trading and retail traders get such a small number of concentrated ideas from the media and on social media. Okay, it's because you're short on time. Like, people are always looking for a hack, right? A shortcut or a hack to making great riches in the financial markets. And obviously there's a lot of people, bad people in the world, that are more than happy to sell you the platform, the idea, whatever it is, for you to get that shortcut. Okay. The point is that it's not a consistently profitable strategy, because let's say one works. Let's say you find a guy online who comes up with an idea. You follow it. You make some money out of it. Okay. What are you going to do next? Are you just going to spend your life like trawling the internet, trying to find the next guy who's going to give you an idea? It never works over the long term. So of course you always hear about, the one or two trades that people do well on, but you're going to have to do this forever. Okay, if you want to be a good trader, you've got to look at it and say, what am I going to be in the year 2025? Am I going to be another one of these monkeys who goes around the internet constantly looking for the next idea that's spoon-fed to me? Or am I going to generate my own ideas and I don't listen to anybody? Now, if that's the case, you want to be the guy that doesn't listen to anybody and comes up with their own ideas. You've got to learn how to generate those ideas. And the PTM does that. It's a combination of top-down and bottom-up fundamental analysis. Okay? And what that does is it gives you a bias. It gives you a bias of long or short. And then you work around that bias and you look for catalysts. Now, a trade idea is not a trade idea unless there's catalysts that are going to occur within the 20 to 60-day time horizon. What you're looking at, if you've come up with something that's fundamentally good, okay? So let's say you think it's a long. If you come up with something that's fundamentally good, but it doesn't have any catalysts in the 20 to 60-day time horizon, what have you come up with? You've come up with an investment. You haven't come up with a trade idea. A trade idea is something that's going to move before a certain deadline. And the deadline for trade ideas is something that still constitutes a trade, which is anything up to 60 days. So when it comes to ideas, guys, you've got to be able to come up with a couple of ideas every week. There's no shortcuts, unfortunately. You've got to show up. You've got to show up and get a few ideas every week, so you can run an inventory of ideas. A good solid inventory for a retail trader of ideas is 15 to 20 ideas at any one time. And then you'll have 8 to 12 positions in your portfolio. And then there's a couple of ideas dropping off, a few positions dropping off every month. And it's just like a carousel. It's a dynamic moving target all the time. So your portfolio is always changing. But it doesn't change that much. It doesn't change like a day trader's portfolio. It changes by like 2 or 3 positions a month on a 8 to 12 stock portfolio. But you still need to come up with the ideas every week. So 2 new ideas every week, 2 ideas drop off because they're not going to work. Ben, I think your camera's gone off, by the way.
Sorry. Yeah, I'm just trying to answer some of these more specific questions.
So Yiman is asking, the mentors in ITPM, do they adopt a similar process? Or do they have different trading styles? How to select the right mentor? I would say, Yiman, there's an 80% overlap in everything we do. Of course, from our backgrounds, different mentors have different capabilities and specifics in different areas. Okay, but it's an 80% overlap. What you've got to understand is as well, when a retail trader starts out and wants to get to kind of like a professional trading standard, there's a way you do it. You have to teach them in a specific way. So all of the mentors are basically in a position to be able to do it. It's not a problem.
Yeah, I'll elaborate a bit on that. Yeah, there's definitely a big overlap between our styles, but our backgrounds definitely affects, I think, our trading approach. For example, personally, I probably use more technicals than the other guys, and quantitative work because of my background with hedge funds and other big asset managers. I also trade futures, which I probably do a lot more than anybody else. So there are people who are interested in that on the side where, I run quantitative futures models and, I do a lot of coding, programming. So there are definitely differences, I think, in our approaches. But I think overall, we all kind of start with this fundamental process and then move forward from there. I know I get a lot of questions about where we get our information from. And there are, if you know where to look, there are a lot of resources online where to get really solid information from. It's not something I'm going to talk about here because it's a little bit proprietary, I guess. But ITPM has a great resource for information, but there are also other sources out there that are good without paying a ton.
There's a lot of nugget hunting questions coming in at the moment. People want to know exactly what our price targets are for everything for 2021. We're not going to answer nugget hunting questions, guys. Again, all you're trying to do here is copy trade. If I say XYZ stock is going to double, what are you going to do? Monday morning, you're going to go out and buy it. It's completely stupid. You're taking completely the wrong approach.
Yeah, there's definitely a lot of that, and it's kind of pointless because when we get a good trade idea, I don't know. Let's say we want to buy a stock or an option. Well, that doesn't mean that it's always going to be, bullish. Let's say maybe after 2 weeks, something happens, in the market or in the company or in the stock, and then we exit it. And then a month later, people are like, "Well, you told me to buy it." Like, oh, we're out. We took profits 2 weeks ago, dude. So that's the problem. You have to learn how to do this stuff yourself. Honestly. That's the only way to be consistently profitable as a trader is to eventually be independent of anybody else. And I think now, these days, I have some of my guys in mentoring that, they come from this view of following some forum, some chat room, and then, they jump in on ideas, and then they pitch trading ideas based on that, but then they have no idea why they're pitching it in the first place because they got it from somebody else. And now it's becoming more and more and more of an issue, I think. It's going to be the people who can basically isolate themselves from everybody else and sit in front of a computer and come up with their own ideas. They're the ones who's going to be making money going forward.
Luke is asking, is Thailand in April the only mentor event this year? You can do a remote program whenever you want, but that's a caveat based on if the mentor that you want is available. So, what you saw earlier were the Q2 availability in the Thailand program, because that starts in April, May. A lot of the mentors aren't available in Q1 or Q2 at the moment. So you just have to send in your application and we'll see. There's only a maximum capacity that each mentor can do in terms of programs at any one time.
I'm getting some questions directed to me as far as what got me interested in more of the quantitative approach. And I think a lot of it comes from my background as a pilot, where this, everything is kind of checklist data based, and I like to see proof that something actually has meaning. So, I mean, a lot of your process and approach in trading, yes, it comes from your education, but also comes from your personality. So if you're more of a math type of background, yeah, it's normal to be more geared toward the quantitative space. If you're like a super high risk taker in your personal life, yeah, you're more likely to do, punts and YOLO trades. It's like your personality plays a lot with your trading. So you can have 10 people educated the same way, but they probably won't trade, the same exact way, because your personality definitely affects it. And for me, I'm more of a math, numbers, quantitative type of person. So a lot of my trading has that included in it.
Yeah, someone's asking, interesting question. What would be the point in someone sharing a trade on a public forum?
Bragging rights.
To try and get retail traders to move the market? Absolutely. Of course. Because the guy creating the post has got a position and he's trying to pump it. So the YOLO narratives that are out there at the moment, you can pick any moment in time in the last 20 years. There's a YOLO narrative doing the rounds, of course, and then people get sucked into doing it.
So a question also about if our trade ideas is totally, only based on quantitative information. And no, we use quantitative processes to find trade ideas, but then we also use a qualitative approach to find catalysts, which is probably the biggest challenge people have, honestly. Running filters through some formulas is the easy part, but the non-quantitative process is actually, for a lot of people, the most challenging, because you have to actually use your you have to rationalize what's going on now and be able to see how that's going to affect the future. And you need to do that before everybody else does it.
So someone's asking here, are the experts at Zacks, Motley Fool, etc. worth a follow? So the clue is there, dude. They're not experts. They're media companies. All these guys online are media companies, guys.
Yeah, and I think that's kind of a theme here too. Is what resources do we look at, and why ours is better than anything else. And I think yeah, we're not we're all professional traders, and I think our backgrounds can kind of speak for themselves when it comes to that. And a lot of these other stuff out there, people push these stocks, and they are pushed typically by guys who have actually never traded ever. That's why they're all getting sued left and right.
Someone said financial entertainment industry is up 4,000% in 2020. LOL. You're dead right, of course. When everyone's sitting at home, the YOLO narrative has become prevalent. Like the media companies went crazy knowing that everyone was sitting at home. So it's brought a lot of people into the market that unfortunately are going to find out the hard way that trading is not a video game. It's just a question of time.
Yeah, and I think the trend in that is just, it's just getting exponentially worse. Because a lot of people want to trade, and the more people, and most people want to trade, they want to just follow somebody else. That's kind of what's happening now. So this has been kind of blown way out of proportion this past year. So everybody is like, it's an extreme example of the blind leading the blind. And that might, by the way, when that happens, it typically works for a little bit because you just kind of have to get the ball rolling. But then it stops working and nobody has a clue what to do. So that's kind of how that goes.
So someone's asking, do you think that there will be a big correction in Q1 this year for all major stock markets? Well, Ben showed you the indicators and showed you that its market breadth is extremely overstretched. So, the way that works is, as Ben pointed out, it can stay there for a long time. But historically, it's never been at that level. So it's looking very precarious. Now, what do you do in a situation like that? Well, look, most people have pensions, right? Most people have pensions. You're long only. So if the US market and global stock markets collapsed in Q1, you want to be protected. The easiest way to get protection is go and buy some put options. Go and buy some protection. And if it's wasted premium, it doesn't matter. You did the right thing. So what's your view, Ben?
I think, well, first of all we can do is, we look back in history and see what has happened in the past. That doesn't necessarily mean it's going to happen again in the future, but it gives us an indication of something that might happen. And, when you have a situation like this, I think you really need to know what to look at, and not just kind of wait for stuff to happen, because you don't want to be, let's say, net short when the market is just on a tear. You want to wait until things starts to actually show signs of rolling over, which you're not going to know because you don't even know what to look at. So for most people, buying some protection beforehand is definitely could be the right thing to do. But the better thing to do is to know what to look at and position yourself accordingly when things start to move.
God. Guys, honestly, it's amazing, sitting on this side of the Q&A. There's 5 or 6 instruments that everybody wants answers on.
Bitcoin.
Yeah. Bitcoin, gold, silver. It's like watching the mainstream media and Twitter come onto the Q&A. These are all YOLO trades. They're all YOLO narratives, guys. When you're in our position, we have, roughly, at any one time, an inventory of 60 to 80 ideas, okay? And we're completely agnostic as to whether they work or not. We're not married to a narrative. We don't fall in love with positions, okay? And we're going for the, good numbers per year. And we want to make money whether the market goes up or down. And if gold has a good year and we're trading an equities portfolio, we don't give a shit. We just don't care. Like if you look at gold, for example, 1900, 2013, it got wiped out. Everyone got wiped out in 2013. And then people had to wait 7 years for it to get back. Like it's a joke. Like what? People only trade these things because they have no ideas. People don't have any ideas. So they just sit there waiting for the next idea for the media to give them the idea.
Yeah, and it's funny because that's kind of, I see that too with the mentees. A lot of in the beginning, everybody wants to ask about stuff that we don't deal with, right? Like some obscure market or some obscure currency in some country you never even heard about, or how to trade like lumber or something. There are, I think it's like 7,000 or some stocks, in the U.S. And I get just equity ideas every single day. I have more trade ideas I can actually trade, rather than trying to figure out what's going on with Bitcoin. And yes, if you bought Bitcoin at a low and you held it, you would have made a ton of money. And that's like the retail way of thinking. You always see that. It's like, well, if you bought Tesla at 50 cents, you would have made this much money.
If you'd have bought Apple in 2007, if you'd have bought Microsoft in the 1980s, if you'd have...
Yeah, it's stupid. It doesn't matter, guys. It's like, because nobody did that, all right? So, and then they say, well, okay, so here's the next Amazon. Just buy this one stock. So it's stupid, all right? So there are missed opportunities all the time, and so what? There are other opportunities that more than make up for it. I always say missed opportunities. It doesn't bother me at all. I don't think it doesn't even face me. It's like whatever. Because at the end of the day, if you're making money trading, that should be the only question. If you're making money trading, okay, you're doing something right. It doesn't matter, that you didn't buy Bitcoin when it was at the lows. Who cares?
How is a mentoring session structured? Without going into too much detail, 12 weeks, 1 to 2 hours a week, split up into 3 parts: ideas, then portfolio building, then portfolio trading. But they overlap. Like those 3 parts overlap. A lot of nugget hunting questions again. It's kind of like the stock question, guys. But it's like, Anton and Ben, do you think, open quote, insert name of an instrument will go up in 2021, go down in 2021? John asking, are the courses a prerequisite for mentoring? Yes. But the mentoring program includes the programs. So if you book a mentoring program, you can book it for 6 to 10 weeks up front. You get access to the programs. You can do the programs before. And then you jump on the phone with your mentor.
So Andreas asking if you use technical analysis. And yes, if you ignore the price action of a stock, you're a moron, okay? We definitely look for fundamentals, but if you just ignore price action, you're missing a huge portion of trading. So technicals are used, but not in the same way probably that most people use. Most indicators, most like canned indicators that everybody have, they are completely useless. All right, there's no value in that. So when I talk about technical analysis, I talk about just reading price action. Okay, coming up with consolidation levels and price targets and stuff like that, and also for timing. We don't use technicals to find trade ideas, but we use it for timing and management.
Someone's asking any content about tax optimization by ITPM. Germany is ripping me off. Yeah, they were ripping the UK off. That's why they left.
Move out of the country.
No tax courses, unfortunately. Sort yourself out. A lot of people have asked me why I moved to Singapore. Tax is one reason, but also lifestyle and the weather, first world infrastructure, first world banking, everything combined. But yeah, tax is a big reason. So if you're in Germany, my only advice to you would be maybe get yourself a second passport. Go to the Caribbean and get a second passport.
Yeah, and as far as taxes here in the States, I mean, I live in California, so I live in probably the highest tax state. But there are ways around it, okay? Clearly, the simplest way is to trade in an IRA. I mean, I do a lot of my trading in IRA, which is tax-free. So, and if you have, really solid returns, to pay a little bit extra in taxes isn't honestly that big of a deal. It's trading professionally full time is a business, and as with any business, there are costs. I mean, yeah, I could live anywhere where there are much less taxes, but I live where I live because of lifestyle. So, and there's a price for that, right? So, taxes are annoying, but there are definitely ways to, maximize your performance, even if you have taxes you have to deal with. Ben is a socialist. Yeah, no, definitely not.
There's still a lot of freedom-loving hippies in California.
Yeah.
So yeah, like a lot of these high tax countries. I mean, obviously you've got an issue if you can't hold a dual citizenship. But if you hold a dual citizenship or even 3 citizenships, you can decide where you want to pay your tax, right? Unless you're in the US, for example. If you're working in the US and you could renounce your US citizenship. But yeah, for example, like Singapore, if you're a Singapore passport holder, you can't hold any other passports. But if you're located here as a permanent resident, then you pay 0% on capital gains from trading, which is why it's so amazing. But yeah, if you're in a high tax country, you can get dual citizenship. If you're young, make it a project. Go and get a citizenship in 2 other countries where you don't, that's assuming you don't have to renounce your current citizenship. And you can choose the level of tax you want to pay. We always get this question, which online brokers do you recommend? The ones that have signed ITPM contracts where they don't screw over retail traders. So go on the ITPM website, itpm.com/trading accounts. You'll see accounts on the navigation bar, and you'll see the brokers that we use there. Yeah, so we're not going to answer any more questions on taxes, guys. We're not accountants. Sort yourself out.
Yeah.
It's your own responsibility to sort your own tax affairs out. What percentage of fundamental and technical? 80-20, 90-10, something like this. People are asking for targeted ROIs. Institute traders, we teach you to target 50 to 100% a year. So that's on account sizes of 25, 50, 100, 250 grand. When you start getting to like 500 or a million, it gets a bit more difficult. But certainly, the vast majority of retail traders at ITPM, I think our average account size, last I checked, was 48,000. You're looking at 50 to 100% return.
So John here is asking, did the course teach idea generation? Yeah, that is what it's all about. Primarily, it's how we come up with trading ideas and how to manage that correctly. So, for sure.
Is there a minimum? Yeah, 15,000 to do it the way we do it. But that's the minimum ticket entry. It's better, obviously, if you can do it with 25, 50K. Can Forex trading work sustainably over time? The clue is what we said earlier. There's not wholesale opportunities in Forex all the time. The volatility is just too low. And the amount of instruments as well is too low. So you're looking at about 20 currency pairs, 25 currency pairs that as a retail trader you have access to. Are they moving 10% all the time? No. And day trading statistically has been proven, even in the major Forex pairs, over a long enough period of time. And we're not talking, years here, we're talking months, okay? It's a zero-sum game. That's why 99% of Forex day traders lose money.
So this is kind of a classic question also. We get this a lot. I have $20,000. Can I make a living just trading that? No. So to make a living, as just from your trading profits, okay, you got to be realistic about it. If you have $20,000, you're not going to be able to make a living just trading. You need to build that higher. So just keep things realistic. All right. So unless you need $100 a month to live, people typically need a bigger account to trade. Because also keep in mind that even though we have high ROI expectations, because of that, there's also higher volatility. So you're going to have months that are bad. That's just how it is. And people think that, you make 100% a year. Oh, that's great. Yeah, but you might also have months that are down quite heavily. There's a risk reward here, and you can't expect to have high returns if you can also accept high risk. And learning how to lose is actually one of the most overlooked things, in my opinion, and one of the things that people have the most problems with. Is learning how to lose and learning how to psychologically accept missed opportunities are kind of the two big things that it's not really taught anywhere, and people struggle with it. But it's just the reality of what we do. Okay.
What else have we got here? I think we're running out of questions, to be honest, guys.
It's a lot of repetitive stuff here. I think so.
Yeah. I'm not sure what this guy's on about. If you pass all 3 levels of the CFA, do you still need to do all 3 courses before getting into a mentoring program? What the hell has the CFA got to do with us? It's like, I don't understand what you're on about. There's a few people asking if they can see the prices for the programs. So I'm just going to leave this here for a second. Someone just asked, what do I need in my CV to get a job at a hedge fund? You need to know how to trade and make money. So it's not about what you write on your CV. Like, people at hedge funds and investment banks aren't stupid, guys. As soon as you get yourself in the interview room, they're going to tell if you've been a trader or not. Okay, guys, I think we've come to the end of today. Finished up a little bit early from schedule. Someone's asking, are the prices in US dollars? Yes, of course they are. They're not in Aussie dollars or Zimbabwean dollars. They're in US dollars. Okay. All right, guys, so I guess the conclusion for today is the stuff that's occurred in 2020, the dynamics that 2020 has thrown up in the financial markets, especially for retail. I guess today we were basically just showing you the indicators and what's happened to warn you that things could actually change now very, very quickly. And if you want to do well in 2021, you need to really avoid this classic banana skin that generally comes around every business cycle. Okay, there's always a few times in a business cycle when things get to absolute extremes, like Ben showed you, and people get caught out. And the people who get caught out generally are the millions of retail traders who don't know what they're doing. And 2020 brought in a lot of people who have never been in the financial markets before. So guys, be careful. 2021 is going to be a tricky year. If you're a long short portfolio manager, doesn't matter what the market does. You can make money on the way up. You can make money on the way down. You can have a diverse portfolio. You just keep churning out the numbers. You can be very agnostic. So if you want to get involved, drop us a message through the website. We'll be happy to help. Until then, guys, adios, and hopefully have a good 2021.
Yep.
Ciao.
Happy New Year.
See you guys. Bye.